We all know Bitcoin's price moves can be spectacular, but its recent plunge was something else entirely. It was fast, it was brutal, and it left pretty much everyone asking one simple question: why? So in this explainer, we're going to play detective. We're going to follow the clues to piece together the story of this massive crypto crash. Okay, let's dive right in.
To really understand the fall, you first have to appreciate the height. At its absolute peak, the entire global crypto market was valued at a staggering $4.4 trillion. That is a truly massive number, built on just this tidal wave of optimism and investment.
And then, this happened. In a remarkably short period of time, the market's value was just slashed, falling all the way to roughly $2.4 trillion. Suddenly, that peak was just a memory. A brand new and pretty harsh reality was setting in.
So let's just let that sink in for a second. Nearly $2 trillion in value was just gone. That's not just a correction. In any market, that's a cataclysmic event. So the big question we got to ask is, was this the result of some single catastrophic failure, or was it something way more complex? All right, let's start digging.
So our first stop is to look at the clues inside the crypto market itself. And to really understand what went down, we need to talk about one of the most powerful and dangerous tools in any trader's toolbox: leverage.
So what in the world is leverage trading? Well, think of it like putting a financial magnifying glass on your money. It lets traders make these huge bets with borrowed cash. Now, when the market goes their way, the profits are absolutely massive. But, and this is the big but, when it turns against them, those losses get magnified just as much, and things can spiral out of control like really fast.
And boy, did they spiral. In just a single 24-hour window, you had a jaw-dropping $1.24 billion in long positions, bets that Bitcoin's price was going to go up. They were all forcefully liquidated. This creates a domino effect, a cascade of forced selling that pushes the price down even further and even faster as the system just automatically closes out all these failed bets.
Here's the thing, this wasn't just small-time traders getting wrecked. As the analytics firm CryptoQuant put it, institutional demand has reversed materially. Basically, the big players, the institutions that everyone thought were propping up the price, they were running for the exits. The so-called smart money was selling.
And you can see exactly where a lot of that selling was coming from. Those ETFs, the exchange-traded funds that were built to make it super easy for big money to invest in Bitcoin, they started bleeding cash. We're talking more than $2.9 billion pulled out in less than 3 weeks. So this wasn't just a leverage problem anymore, this was a full-on institutional retreat.
Okay, so that's what was happening inside crypto. But that's only part of the story, because the crypto market, no matter how much people wish it were true, does not exist in a bubble. It's tied to the wider financial world, and when Wall Street sneezes, crypto can catch a serious cold.
And yep, that's pretty much exactly what we saw. Bitcoin's crash didn't happen in isolation. It was marching in lockstep with a big sell-off in the traditional stock market, especially in the tech-heavy NASDAQ index. See, when investors get nervous about the economy, the first things they tend to sell are their riskiest assets. And right now, that list includes both tech stocks and Bitcoin.
So what had everyone so spooked? Well, this quote really nails it. The market fears a hawk. Now, hawk is just Wall Street slang for a more aggressive Federal Reserve, one that isn't going to be so supportive of the economy. That whole era of easy money that fueled all this speculation, it looked like it was coming to an end, and that sent a chill through investors across the board.
All right, this brings us to our third and maybe most important factor: plain old psychology. Because all this selling pressure from inside and outside the market didn't land in a vacuum. It hit an ecosystem that was already super on edge, haunted by the ghosts of crashes past.
And if you look back, you can just see this wave of anxiety building and building. It really kicked off with a massive $19 billion liquidation event a few months back that left some deep scars. Then you had that constant drip, drip, drip of money flowing out of the ETFs in January. So by the time Bitcoin actually broke through some key price floors in February, the market was already wired for panic. The automated trading bots kicked in, and the sell-off just went into overdrive.
And you absolutely cannot forget the trauma of past collapses. The failure of the FTX exchange was a textbook example of how leverage and shady connections could bring down even the giants. That memory is still incredibly fresh, so traders are way quicker to hit the sell button now, fearing another huge meltdown is just around the corner.
Okay, so we've looked at the internal mechanics, the outside pressures, and the psychology of the market. Let's pull all these threads together and figure out what really caused this crash.
And here's the bottom line. There was no single smoking gun. This was a perfect storm. You had this huge wave of forced selling from over-leveraged traders crashing into the market at the exact same moment institutions were yanking their money out. Then you layer on top of that the panic spreading from Wall Street, and it all hits a market that was, frankly, already psychologically brittle.
And this gets to a deeper truth about Bitcoin. This kind of wild volatility isn't necessarily a bug. You could almost say it's a feature. I mean, think about it. You've got a fixed supply that can never change, reacting to demand that swings wildly, in a market that's open 24/7 all over the globe and is now super sensitive to big economic news. It's basically a recipe for explosive price moves in both directions.
So that leaves us with the ultimate question, right? Is this extreme volatility a fatal flaw, something that will prevent Bitcoin from ever becoming a stable, mainstream asset? Or is it simply the price of admission, the unavoidable consequence of a truly global, decentralized, and scarce digital commodity? The answer to that will likely define its entire future.